Hey there. Welcome to part 5 of the Entrepreneurship Glossary series, Funding and Investors. In this session, we are going to cover 18 essential terms that every founder must understand before walking into an investor meeting. Now, because the moment you step into the world of funding, things actually change. The language changes, the expectations change, and most importantly, the stakes become much higher. If you don't understand these terms, you may end up giving away too much equity, agreeing to bad terms, or losing control of your own company. But if you understand them well, you can raise money smartly, scale faster, and still stay in control. So let's begin. Now, before we go term by term, let's quickly look at all 18 concepts together. These are not random terms. These are actually the life cycle of a startup. You begin with Bootstrap using your own money. Then, comes pre-seed, the earliest earning funding, which we actually called the earliest funding, external funding. Then angel investors, uh, individuals who bet on you early, they come as angels and give you money. So that's why. And then the seed round, where you start building seriously. After that, you enter structured growth. We call it as Series A, Series B, and Series C. Along the way, you deal with venture capital, valuation, equity, dilution, and then more advanced concepts such as cap table, who owns what, then the term sheet, investor conditions, right? Then safe notes and convertible notes. These are actually funding instruments. Before investment closes, there is something called due diligence. And then there's something called survival metrics. You have runway, burn rate. Finally, the outcome, which is exit or IPO. By the end of this session, you won't just know these terms, you will understand how they connect into one complete system. So let's start with the most fundamental concept that's called bootstrapping. What it actually means. So, bootstrapping means building and growing a startup using your own savings, revenue from early customers, and your personal resourcefulness without taking any external investment or external funding. So, in plain English, if I have to put it, in simple terms, let me just do that. You own 100% of your company. There are no investors, no board pressure, no external expectations, but there's a trade off. You grow only at the speed your customers are willing to pay you. And why it matters? Bootstrapping creates something very powerful that's called discipline. Because you don't have extra money, you cannot actually waste it. You don't build features because they sound exciting. You build only what customers will pay for. Let's take a real example. A powerful Indian example, which is Zerodha. Zerodha reached over 1,000 crore rupees in revenue without raising a single rupee from investors. Think about that. No dilution, full ownership, profitable growth. Okay, now let's understand Bootstrap versus the VC funding that we actually get. Right? So we have to compare basically bootstrapping versus the VC funded startups. Uh, what happens is ownership. If you would take one parameter as ownership, Bootstrap will have 100%, VC funded will be diluted by 20% to 40% or even more sometimes. But there are no fixed rules as such. Speed, if you talk about Bootstrap ones, depends on your revenue. VC funded will be faster, fueled by investor money. They come with a lot of connects as well. Then pressure, Bootstrap, no market pressure. VC funded investor expectations and timelines, of course. When you talk about control, you have full control in Bootstrap, but in VC funded, you have to it's shared with board and investors because there are a lot of people on the cap table. What is the risk involved? Your personal money is obviously there in the Bootstrap, but VC funded, the biggest risk is reputation, and there's something called performance pressure. Let's talk about exit. In Bootstrap, it's optional. In VC funded, it's expected investors want returns, right? So the final thing that you need to remember is Bootstrap means own everything, control everything, and build only when the market pays for. Now comes the first external money, which is called pre-seed funding. This is the earliest stage when you don't even have a full product. You just have an idea and maybe a rough prototype. Pre-seed money typically comes from your savings, friends and family, or early believers. That brings us to something called angel, investors. So angels are individuals, not exactly firms, who invest their own money in very early stage startups. Think of an angel as someone who bets on you, but not on your numbers. And they bring more than money: mentorship, connections, credibility. Take the example of Oyo. Oyo received early backing from angels before it had scale. Okay. So let's understand the pre-seed more clearly. Now we move. It's important, right? Pre-seed is the earliest formal funding stage. Okay, and you may not have fully built your product, may not have revenue sometimes that we have actually discussed, right? So in plain English, if I have to put it, pre-seed is basically money to go from idea, first working version of your product. And at this stage, investors are not betting actually on numbers. They're betting on the founder, the problem, the vision. Maybe the market size is really big, right? Typical size, if you talk about, is it ranges from 10 lakh to 2 crore is what you may get. Globally, it could be like $50,000 to $500,000, right? This is not big money, but it's critical money because this is what helps you move from zero to something real. Okay. Take an example of Misho. Misho raised around 1.1 crore as pre-seed funding, right? From IN, fund in 2016. And that time, what happened? They were not a very giant company, of course. They were just testing an idea, right? So it's like social commerce. That early belief turned into a $1 billion company today. Okay. So the key insight here is at pre-stage, there is uncertainty, there is risk, but there's also maximum upside. Okay. Let's understand who is this angel investor, okay, who often funds this at this stage. Okay. So he's an individual with a high net worth, right? That's one, who invests their own money into early stage, startups in exchange for equity. The important point to note here is it's their personal money, not institutional funds. Okay. If I have to explain to you in plain English, an angel is someone who believes in you early when you have, very little proof, maybe just an idea, just some energy, just some conviction. And in return, they take a small ownership stake in your company, right? What angels bring, of course, angels don't just bring money, they bring experience, mentorship, introductions to future investors, right? They help you with a lot of connects because they have deep understanding of markets as well. Sometimes the right angel is more valuable than the money itself. Okay. Take the example of, again, Oyo. So the founder is Ritesh Agrawal, as you know. He received early funding from angel networks like, Venture Nursery before Oyo had scale. Let's take the example of Sanjeev Vikchandani's Naukri.com, right? He has angel, invested in, let's say, 50 plus Indian startups, and in fact more than that, I guess. These early bets create massive impact later. So the key insight here is angel investors invest before the world believes in you, and that is why they take higher risk but also expect higher returns. Okay. So pre-seed is equal to early money, and angel is equal to early believer. Okay. So every big company you see today once needed someone to believe in them early, and that belief often becomes angels. Hope that's clear. Okay. So let's now understand the two terms here, that is seed round, and then we'll obviously then go ahead with series A, B, C, and write many more. Okay. So first we'll start with seed round. Right. What it means is it's the first significant external funding round. And this is where you raise money to build your product properly, hire your first core team, and acquire your first, real customers. Think of this like planting a seed. You already have an idea, maybe a basic version, But now you need resources to test whether this actually can, become a big business, right? Typical size is around 50 lakhs to 5 crore. Globally, it could be $500,000 to $3 million. Right. The numbers can vary, but this is how it is. This is much higher than the pre-seed money that we actually discussed because now expectations are higher. Right. So who invests? That's the question. These are usually funded by angel investors. Angel investors can also be there, then micro VCs, venture capitalists, then early stage funds. Take the example of Zepto. Zepto raised around $1 million as seed funding from Y Combinator in 2021. Now, let's understand what they did with that. Within just 6 months, they built and launched the 10-minute delivery in Mumbai. That's the power of seed funding. So money plus speed is equal to momentum. So the key insight is very simple. And for that, you need to understand this question. Does this idea have a real market? If you have an answer to this, seed funding will do that. Let's move to the next part, that is Series A, B, C. Okay. Let's understand the big picture first. Each of these rounds represent a different stage of growth. Okay. And each stage has a different expectation. For example, Series A, it's all about proving your model. Series A is the first major institutional funding round. So when I say institutional, it means it's not done by one individual. It's actually an institution. At this stage, what happens? Your product works, you have some revenue, you have early traction. The goal now is to prove that the business model actually works. Okay, money is used for hiring team, improving products, scaling initial operations. In Series B, scale what works. Now, right? So it basically means your model is proven, revenue is growing. The goal here is scale aggressively. That means expanding to new cities, maybe increasing marketing, building larger teams like that. Okay. Series C is all about dominating the market. Okay. At this stage, what happens? The company is already large, growth, right? And the growth is strong. In fact, I'll tell you. So the goal is to dominate the market. This could involve international expansion, acquisitions, or preparing maybe for IPO, initial public offering. I mean, you want to get your company listed on shares on stock market. Okay, let's take again the Zepto story. So Zepto raised seed funding to build the idea. Series A, which was around $60 million. Series B, $200 million. Series C, again, another $200 million. Right. So in a nutshell, if you say seed was for to build that, Series A was to prove, and Series B was to scale. Series C, it's all about dominating. One powerful line to remember for everybody is every founding round is not just money, it's a milestone in your company's journey. Okay. Founders don't raise money randomly, they raise money based on whether they are and where they want to actually go. So the question is not can you raise money? The real question is, are you ready for the next stage? Once we have understood these two, now let's move on to VC, because the term VC was already introduced, and valuation. Okay. So, yeah. So venture capitalist refers to professional investment firms. These are firms, okay, not individuals, that pool actually money from lot of sources, okay, like pension funds, endowments, wealthy individuals, and then invest that money into high growth startups in exchange for equity. Okay, so in plain English, a VC is not investing their own money, they're managing other people's money, which means they have a responsibility to generate very high returns. Venture capital works on one simple idea. One company out of 20 must return 100 times the investment. So let's understand this. Suppose a VC invests rupees 1 crore in 20 startups. Right, total investment is 20 crore. Now imagine 19 startups fail actually. So obviously there's no return. But one startup succeeds, the return is 100 crore. So total return is 100 crore. Profit is 100 crore minus 20, which is 80 crore rupees flat that you actually see. So the insight is, that's why, VCs are not looking for any kind of, safe or slow businesses. They're looking for massive growth, large markets, high scalability. They don't want 2x kind of returns. They want 100x. Okay. There are a lot of VCs in India, in fact, Sequoia, India, then Axel, Matrix Partners, Nexus, Bloom Ventures, right? These firms have backed a lot of startups, a lot of companies like Byju's, Ola, Zomato, and Academy. So the important reality is when a VC invests in you, they are not just giving money, they're buying into your growth story and they will push you to grow faster. Part two is all about valuation. Okay. Now, what is this valuation? The estimated total worth of your company at a given point in time. Now, there are two types of valuations that you see: pre money and post money. Let's understand each of them clearly. Pre money valuation is the value of your company before the investment. So, there's no investment. What is the value of your company now? But once the investment comes, then what is the value of your company, right? That's called post money valuation. The formula is very simple. Pre money valuation is equal to pre money valuation, post money valuation is equal to pre money valuation plus investment amount. Okay, very simple. So, if the pre money valuation, say, is 10 crore, now the investor invests 2 crore, the post money valuation becomes 12 crore. Let's understand the ownership calculation. Okay. So investor invests 2 crore. The total company value is now 12 crore. So ownership will be 2 by 12, which is 16.7% post money valuation, right? The ownership that you see. So the key insight here is uh, this is where founders often make mistake. They think higher valuation is equal to better. But that's not always true because valuation is not about what your company has earned. It's about what investors believe you will earn. So it's a negotiated number, not a calculated one. There's one very important warning, which could be like a very high valuation today can create, pressure later because future rounds must, just justify that valuation. If growth doesn't match, it leads to down rounds, loss of credibility, and so many things. So, very important, powerful line to remember is valuation is not your score, it's your expectation. Okay, so don't chase valuation, chase building a real business because if you build something valuable, valuation will follow automatically. We move on to learning two more terms. They're called equity and dilution, very common, right? Let's start with equity first. So, equity is the ownership in a company. So, if a company is like a pie, and one piece of the pie, whatever shape or size or dimension, that and you is yours, then it's the equity. Think in that manner, okay? But how do you get that equity in exchange of some percentage? Okay, so if you own equity, which means you own a share of that entire thing, right? What is that? Profits, dividends, most importantly, the value at exit. Okay. Therefore, in stock market, people actually go and buy, stocks and shares. I mean, shares, right? So think of your company like a pie. I already explained. Okay. Uh, so if you own 100% of it, the entire pie is yours. But if you give away 20%, you're left with only 80%. So there are different types of equity: founder equity, investor equity, ESOP, right? So founder equity is owned by founders, investor is given to the investors. ESOP is this employee stock options. You can say given to employees. Each time you give equity, your slice becomes smaller. We'll understand the example that is Flipkart. So when Walmart acquired Flipkart for around $16 billion, the founders, Sachin and Binny Bansal, owned roughly 10%. 10% of $16 billion, if you actually look at, is $1.6 billion. Crazy money. Now, even though they own 10%, I mean, it's really crazy, trust me. So remember, ownership percentage matters, but total value matters more. On the other hand, what's dilution? Okay, it's the reduction in your own percentage, ownership percentage, okay, when new shares are introduced. So this usually happens when you raise funds or you give ESOPs, right? Every time you raise money, you're actually giving away a part of your company, which means your percentage actually goes down. Let's take a simple calculation. You start with 100% ownership, do the first seed round. Then you give away 20% to investors. You're left with 80%. Do a Series A, you give 25%, right? And you're left with 60% then. So the final ownership is you have only 60% of the company. Important thinking that you need to have a mindset here is this may feel bad that your ownership is actually getting reduced. Okay. You went from 100% to 60%. But think it differently. Okay. Let's take one scenario that you own 100% of a 10 crore company, which is 10 crore value, right? Uh, so scenario two is you own 60% of the 1,000 crore rupees company. What's the value? 600 crore. So which one is better, 10 crore or 600 crore? This is why dilution is not always bad. So one powerful line to remember, it's better to own a smaller piece of large company than to have a large piece of very small company. So dilution is powerful, but only if it is done wisely. Okay, if you dilute too fast, you lose control. If you don't dilute at all, you may not grow fast enough, right? So the goal is not to avoid dilution. The goal is to dilute strategically and grow exponentially. Yes. Now that we have understood these terms, it's important that we understand something called capitalization table. For very formally also and very colloquially also, it's referred to as cap table in short. Nobody calls it as capitalization table, but it's called cap table. Okay. So let's start with something that is really powerful here. Okay. So capitalization table or cap table, as I mentioned, is a document. It's actually a document that shows who owns the company, how much they own, and in what form, which means it includes, of course, founders, investors, employees, everything, right? Their percentage, number of shares, everything else. Okay. So if you have to understand in plain English, think of the cap table as the ownership map of your company. It tells you clearly who has the power, who has influence, who has ownership, right? And how much ownership is actually getting changed over time, right? So let's say your startup looks like founder has got 80%, investor 15%, ESOP 5%. Okay, 100% is clear. Now, how it changes over time? Imagine you raise another round, you give away 20% to new investors. Now, the cap table will change. The founders, it will reduce, investors, it will change, new investors get added. This keeps evolving after every funding round. Investors always check your cap table because it tells them how much ownership is already diluted and how much room is left, whether founders still have control or not. Okay. Many founders make this mistake, giving away too much equity too early. And what's the result? Later, investors lose interest because founders don't have enough stake left. Okay, so the key insight is a clean cap table is, you know, higher investor confidence. A messy cap table is like, deal risk. The next term here is the term sheet. Okay, now, what is this term sheet? It's a document again that outlines the key terms and conditions of an investment deal. It's not the final agreement, but it defines everything that follows. Think of this as a rule book of your funding deal. It answers how much money, at what valuation, for how much equity, and with what rights. Okay, so a typical term sheet will include valuation, how much your company is worth, equity given, percentage you're giving away, then board rights, who gets the decision making power, then liquidation preference, who gets paid first during the exit. So when you actually exit or sell the company or whatever, then in that case we'll get the first money. Then there's something called anti-dilution clauses, which means protection for investors if valuation drops later. The critical insight here to note is most founders focus only on one thing, and that's called valuation. But smart founders focus on terms because terms decide control, payouts, future flexibility. So here's the real thinking. Imagine there are two offers. Offer A, which gives you 10 crore valuation, but the terms are really harsh. Offer B is like, 8 crore valuation, but founder friendly terms. Now it's time for you to decide. Okay. Most beginners choose A, right? Smart founders actually choose B because in the long run, terms matter more than valuation. One powerful line to remember here is valuation gets attention, but terms decide outcomes. Okay, so as a founder, you're not just building a company, you're negotiating your future. So don't just sign a deal, understand it. Now, before we understand something called a safe note or a convertible note, Let's understand the problem they're solving, right? At a very early stage, your startup usually has no stable revenue, no clear valuation, and a lot of uncertainty. So when an investor asks, what is your company's worth? You don't really have a solid answer to that. And if you fix a valuation too early, it can either undervalue you or create problems later. So instead of deciding valuation today, founders and investors use invest instruments like safe and convertible notes. Now these allow you to take money now and decide the valuation later. Let's take the example of safe. Now safe, it's like an acronym. First of all, it stands for simple agreement for future equity. Okay, most of the Y combinators actually they have introduced and they're using safe notes. So it means an investor gives you money today and receives equity later when a proper funding round happens. In simple terms, it's like the investor is saying, I trust you now, give me shares later. So this is something like, you don't have to decide to the valuation immediately, right? There's no interest, no repayment, and it is not a loan, first of all. So it's good. This is simply an agreement that converts into equity in the future. We'll work out with some math. If an investor gives you, let's say, 50 lakh rupees using SAFE, and later you raise a round at 10 crore valuation, then that 50 lakh converts into shares at that stage. So safe is simple, fast, and very founder friendly. Now let's understand convertible notes. A convertible note is slightly different. It is actually a loan given to a startup which later converts into equity. That's the difference. So unlike safe, this starts as debt. It usually includes an interest rate and a maturity period. That means if the company does not raise funding round in time, the investor can technically ask for repayment. For example, if an investor gives 50 lakh rupees at 8% interest, after 1 year, the amount becomes 54 lakhs. When the next funding round happens, this 54 lakh converts into equity. So convertible notes are more structured and offer more protection to investors. The key difference is very simple. SAFE is not a loan, it's a future equity agreement. Convertible note is a loan first and equity later. So SAFE is simpler and flexible. Convertible notes are more formal and slightly more complex. At very early stages, founders often prefer SAFE because it's faster and easier. But in some cases, investors may prefer convertible notes for additional protection. The important thing to remember is both these instruments help you move forward without getting stuck on valuation too early. And at that early stage, speed really matters. The faster you raise, the faster you build. Now that we understand how funding happens, let's talk about what happens just after investor gives you money. And this stage is called due diligence. It's basically a complete background check of your startup. So investors don't just rely on your pitch. They will verify everything. They look at your financials, your legal documents, your customer data, your contacts, your team, even your compliance. Because once they invest, they're taking real risk. So in simple terms, due diligence answers one question: is everything the founder is saying actually true? If everything checks out, right, the deal moves forward. If everything looks unclear or risky, the deal may slow down or even stop. That's why transparency is extremely important. So don't try to hide problems. Good investors don't, expect perfection, but they do expect honesty. Now let's move to a very practical concept called runway. Runway tells you one simple critical thing: how long your startup can survive before it runs out of money. The formula is very simple. Runway equals total cash available divided by monthly burn. Let's understand this step by step. Suppose your startup has 60 lakh in the bank, and every month you're spending 8 lakh more than you earn. So your monthly burn is rupees 8 lakh. Now divide total cash by monthly burn. 60 lakh divided by 8 lakh is 7.5. So your runway 7.5 lakhs per month. That means if nothing changes, your company has only 7.5 lakh, months left before the cash runs out. This is why runway is so important. It focuses you to think clearly. Do you need to raise funding soon? Do you need to reduce costs, or do you need to increase revenue faster? Strong founders track runway every single month, perhaps every 2 days or 3 days. Okay, because in startups, growth is important, but survival comes first. Always remember this: your startup doesn't fail when profits are low; it fails when cash runs out. Now let's build on what we just learned about runway and understand the concept that drives it. It's called the burn rate. So burn rate is simply how fast your startup is actually spending money. More specifically, we focus on net burn. Net burn is calculated as your total monthly expenses minus monthly revenue. Let's understand this number. Suppose your startup spends 15 lakh rupees every month and you're generating revenue of 7 lakh per month. Now subtract revenue from expenses. 15 lakh minus 7 lakh, you're left with 8 lakh. So your net burn is 8 lakhs per month. This means every month your company is losing 8 lakh in cash. And this is the same number we used earlier to calculate runway. The higher your burn rate, the shorter your runway. The lower your burn rate, the longer your survival. And this is why founders constantly track burn rate, because even a small change in burn can significantly extend your runway. Let's take another example. If you reduce your burn from, let's say, 8 lakh to 5 lakhs per month, your runway increases immediately without raising any funding. So burn rate is not just a number, it's a control lever in your hands. Now let's move on to some, the final concept that is called the exit. Exit is the moment when founders and investors actually make money from the start. Until this point, most of the value is all on paper. Exit converts that value into real terms. There are three common types of exit. The first is, the acquisition. You might have heard, right? This particular company has been acquired. This is when a larger company buys your startup. A well-known example of Flipkart, right, which I just gave. And Flipkart was acquired by Walmart, $16 billion. What we now the second is called the merger. This is when two companies combine to become one larger company. And the third one is the IPO, initial public offering. This is when your company gets listed on the stock market and the public can buy shares. At this stage, your startup becomes a public company. Now, here is the key insight: investors don't make money when they invest, they make money when they exit. And that is why every funding decision, every growth decision is ultimately linked to one question: how will this company, exit? So remember one thing: burn rate tells you how fast you're spending, runway tells you how long you can survive, and exit tells you how value is finally realized. And together, these define the financial journey of every startup. Now we come to one of the most exciting milestones in a startup's journey, and that's called the IPO. IPO stands for initial public offering. We've already just discussed, but let me just elaborate. It means that a company offers shares to the public for the very first time. Until this time, the company is privately owned. Ownership is limited to founders, investors, and early employees. But after an IPO, anyone can become a shareholder. The company gets listed on the stock exchange, and its shares can be bought and sold by the public. Right. Now, let's understand why companies go for an IPO. The first reason is raising a very large capital. Through an IPO, the company can raise large amounts of money from public investors. The capital can be used for expansion, new products, scaling operations. Second reason is liquidity. Before an IPO, founders and early investors hold shares, but they cannot easily sell them. After an IPO, they can actually sell their shares in the market, convert their ownership into cash. The third reason is credibility. A publicly listed company gains more trust in the market because it's now regulated, audited, and transparent. But IPO also comes with challenges. The company now faces public scrutiny, quarterly performance pressure, and constant expectations from investors. Every decision is watched closely. Let's understand this with a simple example. Before IPO, you're building in private, right? After IPO, you're building in actually public. That means your performance, your growth, even your mistakes are visible to everyone. Now, here's the most important takeaway. IPO is not the end of the journey. It's not the finish line. It's actually the beginning of a new phase, a phase where the company must know now, deliver constantly under pressure at a much larger scale. So remember this clearly. IPO gives you capital, liquidity, and credibility, but it also demands discipline, transparency, and performance. And only strong companies can sustain that journey. Let's quickly bring everything together because we're going to do a recap. We started with Bootstrap, right? This is where the founder builds the company using personal savings and early revenue with full control but slower growth. Then we move to pre seed, the earliest external funding stage where investors are betting on the idea and the founder, not the numbers. After that came the angel investors, right? Investors who invest their own money and support the startup at very early stage, often bringing mentorship and connections. Then we discuss seed round. This is where the startup begins building seriously, hiring teams, acquiring initial customers. Next, we moved into structured growth, Series A, Series B, Series C. Series A focuses on proving the business model. Series B focuses on scaling that work and what works actually. And Series C focuses on dominating the market and preparing for large expansion for IPO. Then we discuss the VC, venture capital, professional investors who invest pooled money and look for high growth opportunities with very large returns. Along with that, we understood valuation, the estimated worth of your company, based not just on current performance, but on future potential. Then we covered equity and dilution. Equity is ownership in the company, and dilution is a reduction in that ownership as new investors come in. After that, we looked at the cap table, the complete structure of ownership, showing what owns what in the company, and then the term sheet, the document that defines the key terms of an investment, including valuation, equity, and investor rights. Next, we understood safe and convertible notes, tools that allow startups to raise money early without fixing valuation immediately. Then we discussed due diligence, the process where investors verify all aspects of the business before investing. And after that, we covered runway, which tells you how long your startup can survive before running out of cash. Along with that, we learned the burn rate, which shows how fast your startup is spending money every month. And lastly, we discussed the exit, right? The stage where founders and investors actually realize returns through acquisition, merger, or IPO. Okay. And we discussed IPO, of course, the point where the company becomes publicly, listed, allowing everyone to invest. So if you look at all of this together, it's not just a list of terms, it's a complete financial journey of a startup from idea to funding to growth to exit. And now you don't just know the words. Okay. So before we close, let's step back and understand one big idea. In startups, everything starts with the customer, not funding, not valuation, not investors, the customer. Because if customers don't find value, right, nothing else works. And if customers truly value what you build, everything else becomes easier. So think of this as a simple chain. First comes the product. Obviously, you build something that solves a problem. Then, obviously, you have to talk about the traction, and customers start using your product and paying for it. And only then comes the funding, right? Investors don't create good companies, they invest in companies that are already becoming good. So remember this clearly. Money follows traction, traction follows product, product follows customer. If you get the customer right, everything else will follow. If you get it wrong, no amount of funding can save the business. So don't chase investors first, chase understanding your customer, build something they truly need. And when that happens, funding is no longer a struggle, it becomes a consequence. That's the real game of startups. Thank you so much for watching and listening. Do like and subscribe. Take care.